When investing in individual stocks, simplifying your strategy usually brings way better results. Here's a quick fire list of simple choices you can make to drastically improve your chances of success. The first choice can be explained by this brilliant research from Boston Consulting Group. They looked at the top 25% of stocks from 1987 to 2005. Each of these bars shows the average annual return for those top performing stocks over differing time periods. So for example, the best 25% of stocks each year returned around 35% on average. The top 25% over 3-year timeframes gained 23% annually. Over 5 years, 21%, and over 10-year timeframes, they achieved a 20% annual average. But here's the really cool bit. Each bar is broken down by what's actually caused the share price gains. Not just how much they rose, but why they rose. In the 1-year timeframes, most gains simply came from a change in the multiplier. That's things like the price to earnings ratio increasing for no other reason than people being more willing to buy the stock. No changes to earnings or dividends or anything like that, just more positive sentiment. But by the 10-year mark, 60% of the gains were driven by revenue growth, not dividends, profit margins, or sentiment. Real sales growth. That's what drives long-term gains. Other things do matter, but sales growth matters the most. I only look at stocks with a sales growth of at least 50% in total for the past 5 years, because strong past sales growth is one of the best indicators of strong future sales growth. So just filter down to high sales growth businesses. And because strong sales growth is so important, we need to make sure that the business is in a good position to invest in that growth. Growth costs money, but ideally every dollar spent will bring in more growth than that dollar. And businesses which are able to self-fund that dollar, they're the ones in the best position to grow. Because if they can't self-fund, they'll need to source that investment from somewhere else, somewhere external. And that's either going to be debt or external investment. Neither are ideal, and both can put a straitjacket around a business that might need to pivot or adapt to market changes and competition in the future. Because when a business owes, say, bank debt, quite frankly, the bank cares little about the long-term health of the business. It just wants its loan repaid. After all, getting its loan repaid, that's its business. A bank would be very happy to pressurize a business to sell some of its assets or divert funding away from growth in order to get that debt repaid. But that's not the best thing for the business. So avoid those situations by investing in only businesses that can self-fund growth. And one of the simplest ways to do that is ignoring any business that has negative cash flow. Only look at positive cash flow businesses, because they're already bringing in more money than is going out. So they already have a surplus that they can reinvest into growth. Seek self-funding growth. Check out this research by Jag Capital Management. They took the top 1,000 US stocks and used one metric to split them into 5 different groups. The top group achieved 17.1% annual returns, whilst the bottom group achieved just 7.5%. Regular viewers might already know what that one metric they used to split those stocks was. But if the business world had a devil, this will probably be it. The only thing they split by was the level of debt in the business. The group with 17.1% returns had the lowest debt levels. The group with the 7.5% returns had the highest debt levels. Debt kills businesses. People often think that you need debt as an investment to grow. But the reality is, excessive debt often inhibits growth. There are, of course, exceptions where highly leveraged businesses do go on to have massive growth. But history tells us lower debt businesses tend to perform better. I only look at stocks with a debt to equity below 1. But ideally, I like it at 0.5 or less. Find low debt businesses. Now, if we're going to call debt the business devil, we could perhaps call profit the Holy Ghost. But profit is sometimes a false profit. The whole point of a business is to make profit, right? But there's a good reason I focused on positive cash flow to allow for that self-funding growth from a couple of steps ago, because profit can sometimes be misleading. In fact, profit is misleading more often than you might think it is. This is the latest annual revenue and profit for one of my investments, Uber. But this huge chunk, 63% of the profit, all came from a one-off tax benefit. That's a benefit that didn't happen the year before and it won't happen again. It's a one-off, it's an anomaly, which means all the metrics like the price to earnings or the PEG ratio or the earnings growth will be skewed. So when I was first investigating Uber back in December, I calculated all of those metrics myself after removing that one-off tax benefit. And this kind of stuff happens a lot. Those of you who use my free stock screener tool might have seen Pinterest in the lower risk strategy. I also own that stock. It's a great business, but it's the same story. Their latest accounts have a big one-off tax benefit, and you need to remove it to fully analyze the stock. Always verify profit quality. This next point is super important. It is such a huge advantage that it's just as, if not more important than any of the financial metrics. But I know a lot of home investors, they just don't do this. Please do. At least for most of your stocks, it's one of the major advantages you have. Right now, I own just 6 individual stocks. Here they are. Now, forgetting about financial metrics or anything like that, they all have something in common. My laptop uses an NVIDIA GPU. I use Uber to hail taxis. I use Microsoft products both in a personal and professional sense. I use Pinterest for home renovation ideas. I use Meta mainly for local news and the marketplace. And I use Amazon to buy basically everything, as well as their video service and their professional affiliate scheme. The common link is that I'm a customer of all those businesses, and I have been for years. I was already a customer by choice before I invested in any of them. So I already thought their products were great. It just so happened that over time, each one of those businesses fit into the financial metric parameters I set for my investments. If any of those products get worse, I have a direct insight into it. Regular viewers will know that's the main reason I sold Adobe back at the start of the year. The most tenuous link is Nvidia, because I'm not exactly buying $7 million AI training server stacks. But I specifically bought this laptop because it has an Nvidia GPU, and because Nvidia has had the best reputation for creating the best GPUs for decades. The product is king. If you invest in businesses with great products and great financials, you will win. And if you're not a customer, when you could be, ask yourself why you're not. I could have bought an AMD laptop for about the same price. I didn't. Why? Because I don't think they're as good. If I wouldn't even buy the product, why would I buy the stock? Please don't ignore this step. It requires patience, but in the long run, you'll end up with a portfolio that you love and you have direct insight into. Be a customer. Here's a really simple choice you can make, which not only increases your chance of success, but it also makes investing way less complicated. Let's look over the last 35 years. These are all the periods where small cap stocks outperformed large caps. It's pretty clearly focused around the aftermath of the financial crisis. But here's all the periods where large caps outperformed small caps. It's the majority of the time. In fact, it represents around 75% of that time period, which tallies with my recent research as well. Large caps continue to outperform small caps. We can get obsessed with trying to find really small, obscure companies, but the reality is the larger, more well-known, obvious choices, they usually bring the better returns as well. And what's cool about that is instead of starting off with 5,000 stocks that you have to filter down and research, you can just start with 500. You're reducing your workload by 10 times and increasing your chances of success as well. It's a win-win. Just focus on large cap stocks. You might not realize that sometimes you can buy a stock and immediately be down 5%, maybe even 12%. And it has absolutely nothing to do with the share price dropping. The bid-ask spread is the difference between the highest price buyers are willing to pay, the bid, and the lowest price sellers are willing to accept, the ask. It represents the hidden cost you pay every time you buy a stock. In large caps like Microsoft or Apple, that spread is almost invisible, around 0.03%. It doesn't really make any difference. Move into mid caps and it widens to roughly 0.2%, which is still pretty negligible. Small caps often have a spread at around 0.5%, but micro caps can range anywhere from 2% to 15%, sometimes even more, which would be a disaster, wouldn't it, to buy a stock and immediately be down 15%. You really need to watch out for hidden costs like this. It's just another reason why large caps are often safer investments. Now, other trading fees nowadays are generally a lot lower than they used to be, but even commission-free trading platforms like Trading212 still charge currency conversion fees, for example, although they are super small. But if you're in the UK buying American stocks in dollars, then you will pay a conversion fee. If in doubt, just ask ChatGPT. Does whatever platform you use have any trading fees? And be very careful of stocks with large spreads because you want to keep trading costs microscopic. There are so many stocks to choose from. Like, I guarantee most people have never even heard of 80% of the stocks on the S&P 500. But most investors obsess over the handful trading at stratospheric valuations. Now, sometimes overvalued stocks justify the hype, but far more often they crash when growth doesn't keep up with expectations. Let me show you something quite scary about two really popular stocks right now: Tesla and Palantir. Tesla is currently valued at 177 price to earnings, but even more worrying is its price earnings to growth ratio of 9.49. For some context, Microsoft has a PEG of around 2.5 at the moment, and that's actually still pretty high. Nvidia's is just 1.72. Now, Tesla is only expected to grow its earnings per share by 18.76% per year for the next 5 years. And whilst you might think that sounds like a lot, for a stock that's valued at 9.49 PEG, it's nowhere near what's required. To bring that PEG figure down to a more reasonable 2.5 like Microsoft, which again is actually still quite high, Tesla would have to achieve an annual earnings growth more similar to 70% per year for the next 5 years, not the currently expected 18%. Scary, right? But those are rookie numbers. Palantir, with its current PEG of 17.25, currently has an expected EPS growth rate of 33.1%. To bring that stock down to a more reasonable 2.5 PEG, Palantir would have to achieve 228% earnings growth per year. Nothing's impossible, but for some context, Nvidia, one of the largest growth companies we've seen for decades, achieved a 90% per year EPS growth for the last 5 years. I'm not saying Tesla and Palantir will definitely drop. That would be a really stupid prediction to make. But what I'm saying is the risk is enormous. And when you can choose from literally thousands of companies, what is the point in taking that risk? Even just looking at the S&P 500, just pick one of the 198 stocks with a PEG under 3 and a PE below 50, or whatever you deem reasonable. You'll sleep a lot easier if you do, and you'll probably make more money in the long run. Just ignore extreme valuations. Doing that feeds into a wider point. It's one of the most important points I want to make in this video. If you take just 2 things from this video, I'd like it to be this point and the fact that you should focus on businesses you're already a customer of, which I mentioned earlier on. Because let's say you do ignore Tesla and Palantir, and next year both those stocks go up, which could totally happen. Does that matter? I don't think it does. I think the only thing that matters is that the stocks you do choose go up. You can ignore 99% of stocks and still be an extremely successful investor. In fact, I think it makes it more likely that you will win. That's the cool thing about investing. Unlike so many other aspects of life, if you're not confident in it, just don't do it. The stock market isn't a winner-takes-all situation. There are literally hundreds of winners every single year. All you have to do is just pick 2 or 3 of them. You don't have to spot them all. Ignore most stocks. Just focus on the ones you're confident in. So how do you do that? Well, this is kind of how I do it. This is my free stock screener, and I genuinely use it all the time. It has a bunch of strategies. I focus on the lower risk and balanced risk ones. They both have 7 strict financial criteria stocks have to meet to qualify. And if a stock doesn't qualify for one of those 2 strategies, I pretty much don't consider it. Because those parameters I've set, they're really good at finding high growth, financially strong businesses trading at a fair to low valuation. And realistically, I only need to find a couple of good investments every year, and I'm happy. I don't need to predict the rise and fall of every stock in the market. I just need to correctly predict a few that rise. Right now, between these 2 strategies, only 8 stocks qualify out of the 500 top stocks in the US. And I don't invest in everything that qualifies, I just use those as a basis to do further research. And of course, I like to be a customer of the business. But researching 8 companies instead of 500 is a heck of a lot easier. It gives you focus. I've only added 2 new stocks to my portfolio this year in 7 months. At one point or another, all the stocks in my portfolio have qualified for one of these 2 strategies, and that's when I invested in them. Now, you don't need to use my specific strategies. There are loads of different strategies that work, which are different to mine. But find the one you're confident in, the one that you think makes sense, and then hyper-focus in on those parameters. Ignore everything else and follow a strategy. When you truly start doing that, you'll naturally start to follow this next choice, which is one people get wrong over and over again, in my opinion. The majority of investing content, whether it be on YouTube or in the mainstream media, focuses on the completely wrong ideas. People are obsessed with valuing the market and macroeconomics, and they seem to put hardly any focus into the actual business that they're thinking of buying. But it's the business that matters. Let me tell you something that's not said nearly enough. An individual business can be undervalued even during market highs, but it can also be overvalued even during market lows, even if it's a recession. What the market or the macroeconomy is doing, it doesn't really matter. What matters is what the business is doing. A business could be failing even during a boom market, and it could be doing really well even during a recession. Here's a real recent example from my portfolio. In January, you might remember the market was at all-time highs. It then went on to experience a large dip in April following the tariff announcements, and it's only just really recovered now. It's up 5% from the start of the year. I bought Uber stock here, the 6th of January, pretty close to the all-time market high. Most people would think that was a really bad time to invest, right? But every valuation indicator told me that whilst the market as a whole was highly valued, I think it still is, Uber as an individual business was significantly undervalued. Since then, Uber is up around 40%, all during one of the most tumultuous financial 6 months we've had for years. Focus on the business, tune out the macro noise. It's easy to fall into the trap of staring at live price quotes and letting it dictate your mood. We've all done it. But long-term investing, it isn't about reacting to price swings. You often get situations where a stock might rise 20% following a good earnings call, and then see headlines and accusations of that stock being overvalued. But if you look at the financials, it's often the case that those stocks are trading at even better valuations than they were before. Equally, you often get cases where stocks experience significant drops based on sentiment, but there's been no change to the underlying financial fundamentals. The business is just as strong today as it was yesterday, it's just cheaper. Your decisions should be based around valuation, fundamentals, and product. Never a random price level. That's my opinion anyway. Watch the fundamentals, not the share price. This next point is really interesting because you'll start seeing examples that prove it all the time. If you want to get any reliable information on a business, you pretty much have to do the research yourself. And ideally go to the financial reports, because financial journalism is atrocious. Quite frankly, whether a headline says a stock is doing really well or is doing badly is totally meaningless. Like, in most cases, they're actually quite misleading. Let me give you an example. This is a BBC News headline in September last year, reporting a share price plunge for Nvidia. Why? Well, because Nvidia had dropped around 10%, and that did happen. But what this article didn't mention is the 146% rise that Nvidia had experienced in the 12 months leading up to that point. Pretty funny, right? For a start, I don't think anyone who actually invests would ever describe a 10% drop as a plunge. It happens all the time. But calling a 10% drop a plunge after a 146% gain, that just gives the complete wrong impression of that company's story. Fast forward to 4 months later, and you get this BBC article reporting a 16% drop in Nvidia's share price. What that neglected to mention is that Nvidia was up around 40% since their September article. And it's not just the BBC. Honestly, if you only focused on financial journalism and headlines for your stock research, you'd be forgiven for thinking we were in an eternal financial apocalypse. It's why I spend so much time on this channel showing you data that proves that actually it's quite easy to find good businesses. Our entire system is set up to enable business. But still, not all businesses are good. But on the flip side, to those Nvidia examples, you'll often get really positive reports for businesses which have extremely shaky financials. This article for Beyond Meat was overwhelmingly positive. In fact, there isn't a single negative sentence in that article. No warning at all of potential overvaluation for a company that was making a loss and was trading at a price to sales of 20. For some context, only 3.8% of the S&P 500 trade at a price to sales of 20 or above today. And most of those businesses are really profitable. But if you'd read this article at the time, you'd be forgiven for thinking Beyond Meat was the investment of the decade. Fast forward to now, and that stock is down 98% from its peak in 2020. My advice would be to never trust headlines. Always do your own research, and that includes on anything that I say as well. Now, most investors think that you should buy a wider range of stocks in order to diversify your portfolio, but you shouldn't. And let me show you why. Let's say you diversify a portfolio over 20 stocks. Well, this is what that looks like. That is immediately overwhelming, isn't it? It would clearly be hard to track 20 companies, but that's not even the main problem. Because once you get down to your 18th, 19th, 20th best idea, are they really good ideas anymore? Or are you now just trying to find a business for the sake of diversification, rather than you actually thinking it's a great investment? The legendary investor Peter Lynch, he has a name for this. Diversification. I think it's way more effective to have a portfolio of less than 10 stocks. And then if you want to diversify and lower your risk, which totally makes sense, just introduce an index fund as a big chunk of your portfolio, not loads and loads of individual stocks. That way, you still lower your overall risk through a form of diversification, but you can focus in on finding just the very best investments for your individual stocks. Avoid diversification. This next point is extremely important because even if you pick amazing stocks, you can totally ruin your potential gains if you make this mistake. Different countries offer different tax benefits for individual investors. So as an example, in the UK, you can invest up to 20 grand every year into a stocks and shares ISA, and you pay zero capital gains on those investments. Other countries have similar schemes. Nowadays, you can just ask ChatGPT, what's the most tax efficient way for a British, American, French person to invest in stocks? And it'll tell you, super easy. To hammer that point home, if you invested 20k into the S&P 500 through a tax-free ISA 10 years ago, your total today would be just over 62,000, tax-free. But outside of that ISA, you'd lose up to 9 grand to tax. Figure out the most tax efficient vehicle for your investments before you start investing. Over the last 12 months, just under 3/4 of stocks on the S&P 500 have experienced a drop of 20% or more at some point. That's a scary fact, right? That's during a period where the market as a whole has gone up around 13%. But the vast majority of individual stocks experienced at least one large drop. In the stock market, short term, there are no safe bets. Zero. There isn't a single stock you can buy today that you could be certain will be worth more in 6 months' time. Long term, yeah, I think there are stocks you can be pretty certain about, but 6 months, 12 months, no, there are too many external factors. If your financial goal has a deadline within the next year or two, like saving up for a house deposit or saving up for further education, then the stock market is not right for you. Honestly, there's just too much short-term risk and you can get yourself into a mess. That can be annoying to hear if you're really interested in getting involved in the stock market, but quite frankly, it's the truth. And you should absolutely never use debt to invest in stocks. That is a recipe for disaster. If you need the money within the next couple of years, don't invest. Let me put that stat about 3/4 of stocks dropping at least 20% over the last 12 months into some perspective. A market drop of 20%, that's considered a crash. The worldwide media would go nuts. The April drop following Trump's tariff announcements, a mere 19%, but 72% of individual stocks have experienced their own mini crash in just the last 12 months. Crazy, right? It's just another reason why I hyper focus on businesses that I'm truly confident in. That's why I ignore stocks like Tesla and Palantir, not because I think their businesses are bad. I don't. Palantir is a brilliant business and Tesla is one of the most innovative companies in my lifetime. But it's because their valuations are so ridiculously high. If they dropped 30%, would I really have the stomach to hold? Would I really believe those stocks would go back up? No, I wouldn't. And blind faith, that's not an ideal investment strategy. But when Nvidia dropped 14% within a month back in February, I wasn't terrified at all. I bought more. And when it crashed a further 25%, I didn't sell a penny of it and I didn't lose a wink of sleep because every single metric said that business was fairly valued. Nvidia is now back at record highs, up 67% from its low back in April. If you're not braced for your stocks constantly crashing in the short term, then you own the wrong stocks. It's great practice to have an exact reason why you're investing in a stock, the product, the financials, etc. But it's very easy to do that and then forget about it. But if you do that, you're missing out on a huge potential advantage in the long term. I've been building stock market analysis tools for 7 years, and the huge advantage that gives me now is I still have all of that data from 2018-19, and I can look back at it and see what I got right, but more importantly, I can understand what I was getting wrong. That wasn't the reason I collected that data, but now I can look back at the exact financial metrics of all the stocks I was interested in, and it's changed the way that I approach investing. Regular viewers might know that I pay little to no attention to things like price to book. I did back then though. However, over time, it's become very clear that focusing in on analysis for things like price to book, it didn't help. But focusing on the sales growth, that did. Back then, I didn't really care about being a customer of the business. But I noticed over time, the best results came from the companies where I knew the product was good because I used it. It's really helped me, and I think you should do your own version of this for your investments. When you invest, note down all the financials that you use to help you make that decision. Maybe even a voice recording to your future self of why you made that decision. I have this channel, which is basically my version of that. Trust me, 2 or 3 years down the line, you'll start to see trends. And you'll become acutely aware of what your good decisions look like and what your bad decisions look like. And that will help you become a better investor. You might have decades left in this game, you might as well get better along the way. Record why you invested. The more you understand and get comfortable with why you choose to invest in certain stocks, 2 important things will happen. Firstly, you'll be able to very happily make a relatively quick decision to invest in a stock when an opportunity does appear. And secondly, you'll be able to very happily do absolutely nothing at all when those opportunities don't appear. Sometimes in investing, doing nothing can be just as important. People get an itch to find that new stock, some new gem that they can add into their portfolio. But great investing opportunities, they don't appear every day, especially if you're only narrowing down your search to a specific strategy. You could be waiting months. Like I said earlier, I've only added 2 new stocks to my portfolio this year. Otherwise, I've just invested more into the stocks I already own. And I'm perfectly happy with that. It was Charlie Munger, a much, much wiser man than me, who said, the trick is, when there's nothing to do nothing. And that is extremely good advice. Lastly, I want to finish by showing you 3 questions that you should always keep in your mind. If you can answer these truthfully, I think you'll do well at investing. Am I anchoring to a past price? If the answer to that is yes, that's a problem. The past price shouldn't influence whether you buy or sell. People often hold on to bad stocks for too long and hope that the price will magically rise. But underneath it, they know the business has gone sour. Likewise, people often sell to lock in gains way sooner than necessary. Buy and sell based on the fundamentals, not the price. Am I underestimating the downside? This is particularly true when looking at high growth stocks. What if the earnings expectations aren't met? How bad could that be for the share price? Is your purchase based on a future product that hasn't been released yet? What if that doesn't work out? Tesla shareholders need to ask themselves that question right now. Musk said in a recent interview that the financial success of the company depends entirely on automated cars and their Optimus robot. They're products which haven't been tested in the market yet. What happens if their release is delayed? Is the business as it stands still worthy of its valuation? You don't just blindly say yes to these answers, you need some evidence to back it up. It might be true, just make sure that it is. Am I trading out of fear or greed? Are you getting caught up in the hype of explosive share price growth but ignoring the warning signs of the fundamentals? And equally, are you getting scared by media doomsayers and ignoring the positive signs of the fundamentals? If you have a solid strategy, fear and greed should play no part in your investment decisions. Use these behavioral checklists. They'll help you rely less on emotion and more on evidence. And if you're interested in understanding my investment strategy, watch this video here where I show you the exact parameters I set to identify my investments using a real life example of an investment I made recently, which is up around 40% in just 6 months.